How's it going, everyone? My name is Amos. Welcome to another episode of the Compounder's Corner. In this video, we'll be going over the companies reporting their earnings this week, and we'll be talking about the stock market in general. And apparently, the rumor is earnings reports happening 4 times a year, every 3 months, might be going away. The publicly traded companies, they might only be obligated to do it once every 6 months. I don't know how I feel about that. I think it's less transparency, but it's also going to not allow so much volatility in the day-to-day. There's going to be some good and bad. I don't really have a formulated opinion yet. But before we hop into the podcast, I'll tell you guys what. It's just one of those days where it's absolutely a challenge and a great difficulty to just focus. Why? Primarily because I'm an idiot. Number two, I went for a 5-mile run this morning, which, mind you, it's the first time that I've gone for a run in 3 months because of the pollen season in Japan. The pollen season in Japan is so freaking bad that most office workers, they will literally take a furlough, go on vacation, go to Hawaii, Okinawa, go to the States, go anywhere else and do remote work from the months of like February, March, and April, because pollen is that bad here. So I'm not exaggerating, okay? Which, by the way, I don't recommend that you go for a 5-mile run after taking a 90-day break, because, dude, I was huffing and puffing. My shins, my knees, just everything, my lower body was in pain, right? But anyways, I ran my way to the onsen this morning. And onsen is basically a public bathhouse in Japan. In Korea, it's called a chimjibang. And in parts of Europe, they also have something similar. In the US, it's not really a thing. Because can you imagine a giant bathtub where you'll have elderly folks right alongside children, butt naked, bathing? It would never happen in the US, right? But anyways, it's because we're moving out of Japan soon. I feel like I always talk smack. Like, oh, I don't want to come across as like a complainer or someone that's not grateful. I think living in Japan for the past 4 years has been a hidden blessing. Ultimately, I could boil it down to the cost of living, how safe it is here. That's about where my compliments end. But another thing that I'm going to miss is the onsen, right? When we first moved here, I went to the onsen a lot, frequently, because it's something that I used to do in the States as well. Like, not to a public bathhouse, but what they offer inside of there, I like to do. So I had a voucher, and I still have like 7 vouchers or whatever. So I'm trying to use all of them before we get out of here, which is going to be kind of a challenge in itself. But basically, when I go to the onsen, I do the Scandinavian method, where you alternate jumping into a hot tub, like a jacuzzi, boiling hot, okay? Where you feel like your organs are cooking, basically. And then I'll switch on over and jump into the cold tub. Now, that's what I used to do myself in the States, right? I used to put ice cubes in the bathtub and do cold plunges and all that crap. Yes, I'm one of those idiots that does cold showers and ice baths. But the whole jacuzzi thing, obviously, I can't do. So to have a single location that offers both of that, sign me up, right? Apparently, doing that, it's really good for your circulation, your nervous system, and it helps with muscle soreness. But case in point, doing that, running for the first time in a long time, and then also going to the onsen, dude, I'm shot. I'm so tired. But anyways, in case you missed it, videos that were recently uploaded onto the channel, I uploaded a new ranking of my favorite dividend growth ETFs. Because I feel like when it comes to like a ranking or a methodology of trying to figure out what's the best, what's the worst, you got to be fluid, right? Because as equities and ETFs and stocks have time to bake and marinate and cook in the stock market, they change, right? Their performance, their numbers, their holdings. And as time changes, so did my preferences. So I uploaded that. And then I also uploaded episode 6 of the public portfolio series. And I'll tell you right now, if you're not caught up with the cheese portfolio series, dude, I sold half of my holdings, half of my stocks. So if you want to hear my rationale, go and watch that series after this one. But anyways, on a high level, here are the biggest takeaways from this week's earnings. I don't know what's going on. Right before filming this, dude, I was procrastinating for a good hour. I was like, dude, I don't want to do this. I'm so freaking tired. I just want to stretch, take care of the baby and maybe call it a night. And I was like, no, let's do it. And now I started recording. Strangely enough, I'm able to focus. I think that's what it is with most things in life, right? The hardest part of trying to do anything you don't want to do at that moment, like working out or going to work or working on a side hustle, side project, whatever it is, home improvement project, it's to pick up the hammer, it's to pick up the pencil, it's to pick up the whatever to get started. Like, that's the hardest part. But once the ball gets rolling and you're 5 minutes in, it's like, okay, it wasn't so bad after all. And that's exactly where I'm at. I'm in the groove now. Like, I'm excited. I'm back into it. Anyways, number one, right off the bat, on Tuesday, we've got AMD. I think every investor on Wall Street, they're going to be paying closely attention to them. Do you guys remember 2-3 years ago, I kept uploading videos about AMD, talking about how, like, dude, I'm putting so much of my own money into AMD. Just to remind you, I was early, but I was not late, right? Wait, did that make sense? I was early, but I was not. But anyways, yeah, the thesis held true. I kept talking about how AMD could easily be $250, $300, $350 a share, and at the time they were $120. And I still remember people commenting on my videos saying, you're an idiot. You're going to lose all of your money. What are you even talking about? Because when I was looking at their numbers and the projections and the AI data center movement, I kept thinking about, why is NVIDIA getting all of the hype and attention while AMD's in the shadows? It made no sense to me. But anyways, that boat has sailed, right? I sold for a profit and I just never jumped back in. But if you're investing, it's AMD, congratulations. But also in the AI landscape, we also have Super Micro computers also reporting on Tuesday after the markets close. And I'll tell you what, based on what has been happening with Intel, Texas Instruments, Dell, some of their peers, I think both AMD and Super Micro, they're going to have a solid earnings. But just because they have a solid earnings does not mean their stock price is going to boom, right? Like Microsoft last week, stellar, phenomenal earnings, and the stock was just flat. Meta, I feel like their earnings was fantastic, and their stock actually crashed. So, yeah. But the thing with Super Micro, right, is they were caught with illegally giving China AI servers that had NVIDIA chips in it. So they got in a ton of trouble. Not the company itself, but some of the people associated with Super Micro, like some top brass. So I'll tell you this right now. There's a lot of uncertainty with Super Micro. Definitely not one that I would want to go near. And not too long ago, they also got into hot water for accounting fraud. So it's a company that just has a lot of scandals. You know what I'm saying? It doesn't really make me comfortable. But also this week, there's a ton of blue chip names like Disney, there's Uber, there's McDonald's, Shopify, and even Wendy's. And then there's also fintech players, PayPal, and Fiserv, Affirm, and Block. Block is not on the screen. They'll be reporting on Thursday. And a part of that blue chip household names should also be Kenvue. They're reporting their earnings on Thursday. And then there's also the healthcare and pharmaceutical giants, Pfizer, Novo Nordisk, and CVS. And based on what Eli Lilly said the other day, I think Novo Nordisk should have a good earnings, but their stock price has been pretty mellow yellow. It hasn't really been moving. I mean, it's slowly going up, right? From $35 to like $41, $42. So if you bought them at the bottom at 35, you're probably a happy camper. But if you bought into Novo Nordisk at 55 or 65, and you're seeing how they're only at 41, you're probably still irritated. But I think they should have some good stock price movement, contingent upon their market share, guidance, narrative, commentary surrounding the weight loss sphere. Because Eli Lilly right now is number one. Dude, they're at the top of the game. But there's also more than that. So let's go ahead and look at each day of the week a little closer. So, kicking things off on Monday, the first one that I want to talk about is Berkshire Hathaway. If you remember, I uploaded a video not too long ago talking about the best ETFs in terms of CAGR that do not pay a dividend. And believe it or not, it's pretty hard to find an ETF that does not. I think there was like one or two in the video that I talked about. But a good alternative is Berkshire Hathaway. Now, this is a conglomerate, a business of businesses, mostly associated with Charlie Munger and Warren Buffett. Dude, I've been eyeballing, monitoring, and watching them for the longest time. And their stock price, at least for the past 1 year, it's been relatively flat, maybe even a little in the red. But anyways, over the weekend, Berkshire Hathaway, they had their annual meeting, and they reported their first quarter results. And it's kind of weird because usually it's a big, like a Woodstock get together of just stock market investors with Charlie Munger and Warren Buffett. But now it's with Apple, right? It's a really different vibe. But Berkshire Hathaway is still Berkshire Hathaway, right? They resumed share buybacks for the first time, I think in like 2 years, which means they're buying back their shares because they believe that their share price is undervalued right now. And they bought back approximately $234 million of their own stock in just the past 90 days. And based on what I read, Apple was quite direct about their mistakes. Right? I feel like Warren Buffett and Charlie Munger, they usually try to justify their mistakes of like, oh, well, blah, 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 give excuses. But with Apple, he was like, nah, dude, we done messed up. He said Berkshire Hathaway going in big to Kraft Heinz was a huge mistake. It was a disappointment, and it was the wrong call. And so Berkshire officially divested that position, right? They sold out of it, I think at a loss. And it's kind of crazy, right? Because I feel like that Kraft Heinz on paper for value investing and with what Warren Buffett sees and likes, it makes all the sense. But if you're going to think about the future, dude, Kraft Heinz, yeah, dude, that's just no bueno. So in my personal opinion, I feel like with Apple, because he's the one, I'm pretty sure he's the one that made Berkshire Hathaway put a ton of money into Apple, into Google, into a lot of these tech giants, right? Because I think Warren Buffett and Charlie Munger, they're big on like, hey, if I don't understand it, I'm not going to invest into it. But the thing is, like, I feel like that's good advice. But sometimes you don't need to necessarily understand a good business to know that it's going to be a good business that's going to be dominating, right? And if you know they're going to be dominating, maybe even operating as a monopoly or a duopoly, you might as well put some money into it because you'll get some ROI. And that's why, even though they changed who's driving the bus, I still feel pretty confident in Berkshire Hathaway. I'm not invested into them, okay? And mind you, right now they have about, not quite, I think it's like 390 something, but $400 billion of cash and cash equivalents. Just let that sink in for a bit. $400 billion. I mean, that's kind of crazy to fathom. So I think on one hand, yeah, sure, you could buy into Berkshire Hathaway for their railroad, insurance, Geico, Brooks Running Shoes, Dairy Queen, or you could also buy into them because of their cash treasury, right? Knowing that this is a company that just cannot go belly up because of how much liquidity they have. The same way, I guess a cryptocurrency fanatic or bull would buy MicroStrategy for their Bitcoin inventory. Because Michael Saylor, he's almost doing the exact same thing of just accumulating the Bitcoin. Like, it doesn't matter what it takes, just buy them all now before time runs out, and then we'll deal with the financials later. So, speaking of which, MicroStrategy, along with almost any Bitcoin-related mining company or stock, everybody went on a sell-off at the beginning of this year, right? And I remember MicroStrategy, I think in February, they reached the low of about $104. Okay? At the time of filming or recording this podcast, dude, I think they're going to break $200 a share again. So if you bought into MicroStrategy, their dip, and you were able to time the bottom at 104, I think you would be a very happy camper. I think it's one of those things with like Bitcoin, when they're reaching all-time highs, everyone feels positive emotions about Bitcoin. But then when they go on their annual sell-offs or dips or corrections, everyone jumps off the boat and says, it was all a scam. It was all a Ponzi scheme. But time and time again, people say, oh, past performance is not indicative of future gains. But likewise, you can also look at history to see the predictive behavior and how they tend to do and how they tend to bounce back from certain sell-offs and corrections. Bitcoin, time and time again, whenever they reach a new low, they rebound and reach a new high. The same narrative has been used since the beginning, 10, 15, 20 years ago, right? Oh, Bitcoin, it's all a scam. It's a Ponzi scheme. And then it goes higher and higher and higher. So, yeah. So Berkshire Hathaway, I'm going to tell you right now, I might even buy into them. I feel like, yes, they do not pay a dividend, which I'm not a fan of, but it's such a good, well-run enterprise that my fair value for them is around $5.25. So there is a little bit of upside from their current trading price, but more so, if you bake in the price of next year or 5 years down the road, then I think the fair value should be a lot higher. Man, what in the hemoglobin is wrong with me? I kept calling him Abel, I meant Abel. Please forgive me for my ignorance. But I think also on Monday, Palantir, listen, I think this one is a sticky one because, and I don't mean that in reoccurring or resilient. I mean, I think for the current administration, Palantir is the backbone for law enforcement, for the intelligence agencies, for the military. Yes. But with the midterms pending, who knows what's going to happen to all of those partnerships, relationships, and funding, right? So with Palantir, gosh, it's really hard to say. I almost bought into them when they were around 120, 115. And then 9 out of 10 times, when you have that gut feeling that tells you to hesitate, to pause, to reflect, to think twice, usually it saves your booty, right? And I decided not to buy into them. Now, obviously, had I bought into them at 115 and they popped to 144, I'd be pretty happy. But I'm not going to lose sleep over it. Like, if you're investing into Palantir, I get it. I think when you take their PEG ratio, their SAS rule of 40, and all of that into consideration, they're phenomenal. They're crushing. My whole thing is the line of business that they're conducting, the activities that they're doing, it's very, very controversial and polarizing, right? And to be quite frank with you, I don't think I have the risk tolerance and the stomach to be able to handle the political volatility that's associated with the company. The numbers, the financials, the fundamentals, beautiful. But the business model itself, you know what I'm saying? What else do we have? There's Coterra Energy, which I'm pretty certain they're going to be swallowed up by Devon Energy any second now. Tyson Foods, which is chicken, poultry, meat. There's Grab, which is the Uber of Southeast Asia. Sorry, my throat is... One second. They say, according to the internet forecast and the results, that pollen season is dwindling and is dying down. I mean, I went running today, and my throat has just been super sore because of all the pollen that I inhaled. So, it's kind of hard to talk today. There's also Pinterest. Between you and me, I'm really bearish on this company. I think there was a super investor or an influencer that was really bullish about them. I truly don't see the growth catalyst for this company. So Pinterest, if you don't know, it's a social media platform that a lot of women utilize, especially for lookbooks, outfit ideas, furniture, home decor, or before they get married, their ideal or dream wedding. It's kind of like a scrapbook, a collage of photos that you post on your little home feed. That way you can go look at your outfit ideas, your recipe ideas, your interior design ideas, and all of that, right? Like in the beginning, I think it made a lot of sense. And I think it garnered a lot of momentum because you could go to another human curated, scrapbook to get ideas. Now you go to that platform, it's almost 100% AI slop. AI generated content left and right, and they've lost the meaning of who they are. And when I think about it like that, yes, they have made the pivot to introduce a lot of advertisements alongside with the lookbooks and the scrapbooks, which is why they're still printing a lot of cash. But when I think about how disgruntled the customer base is, like domestically, they're shrinking. The US audience, they're clicking away and they're not even interested in Pinterest anymore. I think a lot of their growth is now in places from like India, Philippines, and other like international countries. I think it's the beginning of the end of Pinterest. I guess that's the point that I'm trying to make. If you're going to invest into social media, why go for a cigar butt in Pinterest, right? I have to be mindful of how I talk about companies, because whenever I talk about a company and you so happen to be invested into it, I always get an angry comment, right? But I mean, it's the reality. Like Pinterest is not an S tier caliber high quality compounder. It's not A, it's not a B. Their grade for me is going to be a D or an F. I'm being super serious when I say that. And I'm really sorry if you're invested into them, but it's just not a good business. So if you're going to be investing into social media, don't do the cigar butts. Look at who is winning. Look at who has a recipe for success that's dominating, right? Meta, Google, TikTok. You can't invest into TikTok, but you can through Oracle because of their stake in TikTok US. That's where my eyes would be gravitating towards. I would not want to invest into Pinterest or MySpace or Zynga or any one of these other outdated social media platforms that are obsolete. Pinterest, count your days. I'm not even trying to be negative, but yeah. And then there's also Hess Midstream, which after getting to know the company, analyzing them and looking into their numbers, it's a midstream oil pipeline mover. Okay, so it doesn't matter how much of a shortage of oil or what the price of the oil barrel is. It doesn't matter. As long as there's oil moving through their pipes, they're going to be printing cash. I would say they're a top 15 high dividend yield payer. So when I think about the other high dividend yield paying stocks that I like Realty Income Corporation, Altria, Hess Midstream is a part of that conversation. I really like them, but I will not go anywhere near them. I will not pay $1 above 30. For me, my entry point is $30. And with the whole Middle East conflict and debacle where every other weekend, oh, the Strait of Hormuz is open. Oh, now it's closed. Now it's open. I just don't want to go near oil stocks right now. I mean, can you blame me? The blatant market manipulation, the volatility, the uncertainty. I'm just like, dude, I don't want to play those games because, first of all, oil and gas is a cyclical business. Right? You never want to invest into when they're at their bull run, because once they go back down to the down valley, you're going to be caught holding the bags. You're going to have to wait a year, maybe 5 years for the market to swing back up. Right now, we're at the height of the height. Like, you know, when you go on a roller coaster and you're at the top before the drop? Yes, that's exactly where we are with oil stocks right now. I could be wrong. And I said, I went on record about a few weeks ago saying, hey guys, I think we reached the peak when it comes to the oil players. If I was invested into Chevron, Exxon, Shell, BP, I would be looking to sell and capitalize on the profits, because I think once this whole Middle East conflict is done, I think they're going to sell off pretty darn hard. Likewise, exact same thing that we saw with the military stocks. I think running up to Venezuela, leading into the Middle East conflict, I think military stocks everywhere across the board, L3 Harris, Lockheed Martin, Huntington Ingalls, it doesn't matter. Every single one of them reached all-time highs. Okay? And now they're all selling off 20, 30, 40% since their all-time highs a few weeks ago. The exact same thing is going to happen with oil, so I'm going to be patient. I like Hess Midstream. I don't like them at $40, let alone $38. I will buy into them at $30. Why is this? Because I actually uploaded a deep dive video on Hess Midstream, I think like a couple months ago. I have their fair value estimate. I think it was like $34, $35. So why the heck would I overpay for them at $40 a share, knowing full well it's a $35 a share company, right? That's why once you understand how to extrapolate the numbers and analyze and forecast a discounted cash flow analysis, once you do all of that, you know how much a company is worth on paper. That way you don't make the mistake of overpaying for them. Likewise, anywhere left and right, the oil and gas, I'm not buying any of them. They're all overpriced right now. If you're invested into them, congratulations, right? You're probably in the green by 10, 20, 30, 50, 100%, which is good. But for someone that's looking to open a position, I'm like, bruh, that's emotions talking right there. That's greed talking. That's the fear of missing out talking, right? You want to jump into it. Likewise, here, if you're new to investing, hear me out. Please, for the love of, I don't know, Warren Buffett's left kneecap that has a few wrinkles, please do not get FOMO. Only buy into a company when you understand why you're buying into it and when you have a solid exit plan. I think the worst thing that happens to new investors is they see a stock rallying and they think it's going to continue rallying to the moon every single day, every single week. But believe it or not, there are such things as short squeezes. There are such things as cyclical highs and lows. There are such things as boom and bust industries. Meaning, when you buy into them, who is to say that tomorrow or the next week, it's not going to transition into the bust phase, into the valley phase, into the decline by 50% phase, right? All I'm trying to say is just be careful if you're new to investing and stay away from speculative crap. Stay away from day trading. Practice learning, understanding, and calculating the numbers. That way you truly get a grasp of how much a company is worth, right? That way you can have a margin of safety baked in and saying like, hey, this company should be $120. Right now they're trading for $80. So what's the margin of safety? $40 to the upside. So if I buy into them at $80, knowing full well it's $120 on paper, that gives you a little more confidence. However, if you do the exact same calculation and you reach a conclusion of 120 and they're currently 160, why in the world would you buy into them at 160? It's like you go to Costco, you want to buy some salmon or some brisket or I don't know, some ribeye, and you know full well that slab of meat is $40, right? But somehow the price tag says 88. Are you going to buy it at 88? No, right? It's probably a good time for you to lose some of that belly fat and be like, you know what? Maybe I'll just get some poop-eating fish tilapia. Maybe I'll just get a little bit of a cheaper variety, some like pork. I don't know. That's just how my brain is set up. I don't like overpaying for a good business. Like it's okay to pay a fair price for a good business, but never a wise idea to overpay for a good business. Because when you don't have a margin of safety baked in, I'm telling you right now, like there are people that bought into high quality compounders while they were at their all-time highs. And yes, for 20, 30 years down the road, not a bad idea, not a bad feeling. But for the 18 to 24 months to follow, as they go through their natural cycle, stock price movement, up and down, you might be in the red, 15%, 20%. But granted, you bake in 5, 10, 20 years, you'll be in the green, yes. But just never be in a rush to buy stocks. Just like with fishing, it pays to be a patient person. That's why when people make fun of Berkshire Hathaway for having $400 billion, I kind of understand the logic. They're waiting to have the perfect opportunity when everybody is financially distressed, when there's an economic downturn, and they're able to pay pennies on the dollar to acquire, to buy out, to have a majority stake in blue chip Fortune 20 companies. And I'm like, you know what? That's not a bad idea. Likewise, we should be doing that on a micro or on a smaller scale. If there's nothing good, be patient. When you're patient, eventually a super solid compounder going on an unjustified sell-off will pop up, just like with fishing. You can't rush it. And when it happens, and they hook right into your freaking, they bite onto your bait and you hook them and you start reeling it in, it'll feel like a gold rush, an adrenaline of feeling like, dang, my conviction, my calculation, my numbers all aligned to this working out. But if you keep jumping into crap left and right, jumping in, jumping out, jumping in, jumping out, and jumping into the next hype, that's the fastest way to lose your money. I'm telling you right now. And that's not even financial advice. That's almost facts. You keep chasing the next trends, you're never going to make money. If you're early to the trends, or if you buy into the trends with a margin of safety baked in, or when you buy into the trends during a pullback or a correction, it's a different story. Then you're playing the game. You're doing the right. But if you're just willy-nilly throwing cash, your hard-earned money, when it's at an all-time high, or not understanding why you're jumping in, or understanding when you're going to exit, I'm like, brother, what are you doing? But anyways, Monday we also have Duolingo, and I'll be completely transparent with you. They have insane numbers across the board. You think about their free cash flow, you think about their balance sheet, you think about their debt situation, just everything about them is phenomenal. It's beautiful. I'm not going to deny that. I could also throw in the trade desk into that conversation. Phenomenal numbers, but the market hates them. So if the market hates them and the sentiment surrounding the company is negative, it sucks. Because no matter how good the financials and the numbers are, the stock, the price, it's stagnant, or it even goes into the red, and it sucks. I think Duolingo, there's unrealistic expectations for the stock. I don't know what they have to do to get back up to 130 or 150 a share. We could also throw in Roblox into this conversation. They just reported the earnings last week. Mind-blowing numbers. Obviously, they do have some headwinds. I think like age verification and some stuff like that that's hurting their growth in daily users. But for the most part, phenomenal across the board, but not good enough, just like Duolingo. So what I have learned, I could absolutely be wrong, but when the market sentiment is that freaking negative, here, let me just show you what I'm talking about. Duolingo, right? This is a company where their top line, the gross sales, the amount of money that they're bringing in is growing at a rate of 38% year over year. The stock market does not care. They don't care. They still are going into the red. You think about their free cash flow situation, their free cash flow is growing by 35% year over year. It doesn't matter. What do I mean by that? What do I mean by that? If I zoom out 6 months, negative 59%. You zoom out 1 year, negative 72% in the red. Right? And that's why with Duolingo, I'll be honest, I'm not even interested. I'm truly not. This is a company where I almost jumped in when they were $100 a share. And I kept thinking like, bro, think about the sentiment. Think about the narrative. Think about, even though the numbers align to being a compounder, I think the pushback is coherent. I think this is going to be the next Chegg. I know that's a rude, or it might be a little too negative or cynical, but I think there's going to be a lot of language learning apps and social media platforms that are going to be sprouting up left and right, that are going to be fighting for the exact same customer base of Duolingo. And I think it's only a matter of time before we start seeing them crash and burn hard. Because Chegg, which was an online learning platform where students used to buy notes for their classes and for their exams and quizzes, like the answer, so they could study it before the exam. Just like Duolingo, their gross sales at one point, it was growing by 56% year over year. And then the following year, 20% year over year. And then they just started falling off a cliff hard because of what? Artificial intelligence and language learning models reproducing exactly what Chegg can do. And that's exactly what I'm thinking with Duolingo. Like, I get it that it's not necessarily a place to learn a language, but it's more so a gamified app where you can scroll for 10 to 15 minutes a day while you're taking a dump on the toilet to feel like you're accomplishing something of the day, learning how to say ni hao in Chinese. I get all of that, but they have zero economic moat. Who is to say that Facebook can't just roll out their own variety and version and flavor of a Duolingo that's already integrated with Instagram, that's already with WhatsApp, right? That's why I'm like, with Duolingo, I'm sorry. Like, I know this is a very unpopular opinion. I think everybody else loves Duolingo. There's a big YouTuber that loves Duolingo. I personally do not. I don't see a future for them. Now, for this earnings, could they pop? Yeah, they could have a short rally. But could they also fall deep into the red? Absolutely. So for me, I'm not even going to be paying attention to Duolingo. It's just going to be one of those business operations tickers that I'm just going to scroll right on by on Monday. I'm not interested. Especially seeing what has happened to them in the past 1 year, 5 years of just getting demolished despite posting good numbers. That says everything. And then there's also several BDCs that are reporting. I should have mentioned that during the high-level overview. There's Blackstone, Secured Lending. There's also Gulab. Right now, for me, I'm a huge BDC bull, right? But it's not the time to buy into them. Okay? I know that sounds crazy, but BDCs are also very cyclical. It depends on the federal interest rates. And right now, they just had their, Jerome Powell had his last meeting being at the helm. Now he's going into a advisory role or whatever. But they said that the interest rates are going to stay flat, right? It's just going to stay as it is because of inflation due to oil, due to the Middle East conflict. Direct correlation, by the way, which sucks. Because even, I know I talked about it a few times. I can't imagine the price a gallon of gas in the US right now. Like, if that doesn't get your blood boiling, I don't know what will. Like, that's so annoying, right? But anyways, BDCs, they're kind of like in a limbo state right now where they've been selling off in anticipation for the interest rate cuts. And for me, that's when I was going to jump in, right? As they go reach their bottom. But now they're trading flat after selling off. So I'm like, but you already know that it's kind of like a Band-Aid being on a very hairy Italian person's leg and you're slowly peeling it off. Like, the interest rates are going to get cut eventually. And when it does, they're going to crash even further, right? So it's like, my brain and logic is, why buy into it right now when I know inevitably in 6 to 9 months, it's going to crash by another 20, 30%, right? So for me, BDCs, I'm going to be patient. I sold out of all of them last year at all-time highs because the writing was on the wall. I knew that interest rate cuts were on the menu. And so I was like, oh, it really sucks to do it, but I'm going to sell out of them and then I'll buy back in. I was going to buy back in once the aggressive cuts happened. But inflation is sticky, which is annoying. It really is. And I'll be feeling the pain of inflation once I move back to the States here in a little bit. But, yeah. Anything else on Monday? Is this Alamo Group the car rental service? Actually, I want to know. No, it is not. They sell industrial management equipment. I thought it was going to be the car rental Alamo, but I was very wrong. Other than that, I think for Monday, that's about it. Let's jump on over to Tuesday, because I think that's where it gets a little crazy, because there's 356 companies. But then again, I want to circle back to how we were talking about with stocks. Make sure that the numbers, the financials and fundamentals are looking good. Make sure that they're not trading for an overpriced, make sure that they're not overvalued at the present tense. Then again, there are some rare times in the stock market. I'm not going to say this is common. I'm not going to say this is a majority of the time. It's really rare. There are some times where the numbers are booty hole. There are some times where their balance sheet is cooked, meaning they're over leveraged. Just everything looks atrocious, but the narrative and the hype is so strong that might be enough to propel the stock price. The biggest example that comes into my mind is Intel. I got it wrong. A couple of years ago, I made a video talking about their turnaround story, becoming a chip manufacturing hub for their own chips. And I kept talking about like, man, I don't know if they can pull this off. Like to execute it is going to be really, really difficult. Lo and behold, they got it done. So I think how that changed my brain is whenever there's a company that's trying to produce a rebound story, a turnaround story, that's in the best interests of the United States with the backing of the government's money, I think for me, I'm going to change my tone in my commentary from being a little cynical negative to being positive. Because I think the government will refuse to allow them to fail. Another example are the banks during the great financial recession. Almost every single one of them should have gone belly up. But the US government bailed them out. You pull up JP Morgan Chase, Goldman Sachs, Morgan Stanley. They're all trading at all-time highs right now. Okay? Some of the airline stocks. Why? Because if we allow these banks, if we allow Intel, if we allow Texas Instruments to fail, that's going to screw the United States interests, but economy as well. Right? And that's why I'm actually going to upload a video very soon talking about what I believe to be the next Intel based on what the government is pumping their money into. It should be a very interesting one. So if you guys want to see that video, please do comment. Please help me, motivate me to do it. Because I'm a stay-at-home dad and dude, I'm beat by the end of the day. Most days. Like obviously right now it's the weekend, which is why I'm able to record. But dude, Monday to Friday, dude, I'm shot. So comment below, tell me that you want to see more videos. Tell me that you want to see that. It would fire me up. Like I'm a self-starter. Like I can motivate myself and everything, but I'll tell you right now, when you're dealing with a 6-month-old first-time dad from 6 a.m. to 6 p.m., dude, it's pretty exhausting. And by the time the mom gets home preparing for dinner and everything else, I just have nothing left in the tank. Okay? But anyways, talking about Tuesday, there's AMD. Friends and family, can we just, they're $360 a share. I'll never, ever forget making videos about this company right here, October, November, when they were like $100, $120. People telling me that I was an idiot for saying that they could easily get to $250, $300. So many people were so impatient, right? They were like, no, AMD, like, oh, this is such a trash company. They're nothing but falling in valuation. They suck. They're $360, right? I was early. I was not late. Now, I wish I would have held on to my shares. I sold out of them for a profit, but yeah, I think AMD right now, they're overvalued. But it just goes to show that it takes time for an investment thesis, for an investing thesis to play out. Some people put money into a stock and expect, say they're $100, like AMD at the time, they expect them to be $250 overnight. It's like, dude, that's not how it works. It takes time for their operations to produce results, for the chips to get delivered, for customers to demand more. It takes time. So if you're invested into AMD, for the 5-year total return to be 340%, congratulations. I'm genuinely happy for you. And then also on Tuesday, we have Shopify, which is a tier 3 SaaS operation based out of Canada. I really like this company, just not at their current valuation. There's Anheuser-Busch. There's Duke Energy, a utility predominantly operating in the South. Pretty good one. Private equity firm, KKR. Let's see, anything. MicroStrategy, like I think I talked about in the beginning of the video, right? 177 right now. At the beginning of this year, they've reached, what is that, 104.17? If you bought them right here, even right here at 120, to see them pop up to 177, the 3-month return is at 18%. What about 1 month? For Strategy, a company that only buys Bitcoin and doing whatever it takes to buy Bitcoin, they do have a legacy software line of business that's kind of like Oracle, kind of like SAP, but crappier. And I think it's kind of losing steam. You don't buy MicroStrategy for their software. You buy into them because you believe in Bitcoin. But anyways, for 30 days, to get a 41% gain is pretty good. So all I'm trying to say is with Bitcoin, the momentum has shifted. I think they reached their bottom for the time being for this cycle, and now they're swinging back up. So I don't really talk about cryptocurrency on this channel, but I think this week I'm going to slowly start buying a little again in Bitcoin. That's not financial advice. It's just I'm seeing the upswing coming back, but it's still at a pretty low valuation. So, because there's multiple ways to do it, right? You could try to buy it as they're going on a sell-off. You could try to buy it near its bottom, or you could try to buy it as it's bouncing back up. And that's my logic. With stocks, I like to buy it when they're at the bottom, right? When it comes to Bitcoin, I try to buy it as it's going in the upswing, as it's bouncing back up. I don't like to buy them on the dips. I like to buy them as they're recovering, if that makes sense. There's Ferrari. Kind of funny that this is a publicly traded stock. There's PayPal, which I think for the past, what do you call it? Yeah, 1 month, they're in the green by 11%. They reached a low of about $39 back in February. Wait, how is it negative 4% for the past 3 months when they were $41 in February and now they're $50? This is not correct. But anyways, PayPal for the past, 12 weeks or so, it's been a pretty good performer. But that sell-off, my gosh. It's hard to turn a blind eye at that, right? When they were $308 back in 2021. But then again, during the pandemic, during the meme stock frenzy, I feel like a lot of tech stocks, finance stocks, everything went to the moon. And it was just, I remember PayPal at the time, their PE ratio was higher than Palantir's right now. Just nothing made sense. But PayPal at a PE ratio of a 9, I'm serious. For the next 10 years, I know that their take rate is decreasing year over year. And how do I know that? Is if I jump on over to is it right here? Financials tab, KPI. Is it going to be right here? Let me see. Yeah, transaction take rate. You want to see how much money they take home from each transaction going up, right? But since 2012, it's only been going down, 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 down. Yes, I know it's going down. It kind of sucks. But with PayPal, I feel like they were punished to the point where it just doesn't make sense anymore, right? So in the next 10 to 15 years, if I had to pick between PayPal and Western Union, I'd rather go with PayPal, knowing full well that Western Union has like a 9% dividend yield. PayPal has a 1%. But Western Union, their business model is doomed, right? It's like investing into a newspaper company in 1999. Right, in the swing of the technology, everything going digital and online. Western Union, I just don't get it, okay? Now, obviously, it's a part of SCHD because of their dividend profile, but I guarantee you Western Union will eventually get kicked out. But I'd rather go with PayPal. Especially with their partnerships, especially with how Apple Pay, Google Pay, Samsung Pay, and everyone is encroaching everywhere else. I think PayPal is becoming like that third-party, unbiased tech platform that companies can trust and partner with if you don't want to do business with the big tech companies. I don't know why you wouldn't want to. Maybe there's bad blood. Maybe you're tired of their business practices. Whatever it is, now PayPal has the opportunity to be the underdog. There's the Korean Amazon coupon, which I feel like not too long ago, they were taken to court by a ton of like former workers by the mistreatment of how they were doing their operations, and they went on a massive sell-off. So yeah, there's coupon. There's Pfizer. So in the fintech space, I'll be completely honest, Pfizer would be my last pick. I would go with PayPal before Pfizer. I would potentially put Block, or I guess Square, as a peer to PayPal, but head over shoulders Pfizer. I think Pfizer, they do have a payment processing kiosk, like a tablet they sell. I think it's called like Clover, and some other lines of business. But I just don't feel confident about their leadership, if that makes sense. And there's Devon Energy. There is Ball Corporation, Super Microcomputer. There's Huntington Ingalls. Now this one, I'm not even going to say that it gets sentimental, but it definitely gives me, you know what I'm saying? Like one of those memories where you always have a fond smile when you think about it, like that time you did that or this. That's Huntington Ingalls for me. I'll never forget how I went balls deep and I invested into them heavily during this sell-off right here. I didn't time the bottom perfectly at 161. I think my cost basis was like, what was it, like 169? But to see it go all the way up to freaking 460, I was a pretty happy camper. Now, obviously, I sold out of them if you watch the public portfolio series, but it's definitely a company that I would love to buy back in. But I do think, like I alluded to at the beginning of the video, the military stocks have a lot more room to fall. And I think they will continue to go on a sell-off as the midterms are pending. Because I think right now, the prediction markets, they're insinuating that Congress is going to flip. Because right now, it's Republican across the board, right? The House, the Senate, and of course, the executive branch. But they're thinking with the way the economy is going, with all of these new conflicts and wars that we're going into, inflation, they're thinking that people are going to switch. So instead of voting Republican, voting Democrat. And consequently, that's definitely going to hurt the DoD and all of the military endeavors. Likewise, I also attribute that as one of the reasons to why the health insurance stocks are pumping again, because they're baking that in, they're pricing it in, that they're going to go into a favorable environment where the government and the politicians will be on their side once again. Also, the Medicare Advantage rates were a lot better than anticipated. I also think that's an attributable, one of the reasons to attribute to their success. But I think predominantly it's their government, because Democrats love health insurance, right? What is it, like Medicare, Medicaid? Republicans hate that stuff, based on my understanding. So, I know people say keep politics out of stocks, but you really can't. You have to understand how politics influences businesses, and then, I guess, invest in what's a better environment based on the government at the time. Or you could just dollar cost average, regardless of who's in office, every single Friday or every single time your paycheck hits your account, tune out the noise, and just dollar cost average, which I would say is the better way to go. It's less stressful. You won't be checking your accounts every single minute because you understand the name of the game. 10 to 12% CAGR over the long run, you'll be fine. But if you want to maximize that CAGR, you do got to follow the news, the business environment, politics. It takes a lot to be an active investor. But you know what? I love it. I think it's really fun. There's Solvitum. They were a spinoff from 3M. There is Skyworks Solutions. For me, I would say they're one of the biggest losers in the chips landscape. DaVita Medical Devices. Match Group. I think that's the parent company of a whole boatload of different online dating apps. To be honest with you, I think I talked about it a few times in the past. I'm not bullish on dating apps. I think we're seeing a renaissance of people longing for that real human interaction again, especially in intimate relationship, especially in trying to find a romantic partner. I think people are they're just tired of being catfished. They're tired of swiping. They would rather meet someone in person. So I told you, steal my business idea. I think pop-up shops, speed dating, where every person is vetted before they're allowed to be a participant. Everybody pays 30, 50 bucks. That gets you a drink. And there is a host that helps moderate the tables, the rotations, the matchmaking. I feel like that, for me, if there was a business like that, I would put all my money into it. Because we have deviated so far from the normal ways of meeting people to everything being online that it's lost the whole idea of what makes it romantic. So I would be more bullish on a dating platform that's based like in Chicago, singles from 25 to 45, like your salary requirements and all of that. Because the reason why I got that idea is I think in China, they actually have something called marriage markets where you'll literally go in person and you'll talk about your background, your salary, what you're looking for, and you'll do matchmaking right there on the spot. And that planted a seed in my head. And I was like, wait, hold on. That sounds out there. But I feel like this current generation of millennials and Gen Z, I think they would love that. And don't even get me started on senior citizens or people that are 55 or divorced. I think they would like that even more because they don't want to be fumbling or messing around with online dating because one thing leads to another and you're talking to a Nigerian prince or a dude that's trying to scam you from Bangladesh, right? Just using pictures that they generated from AI. No, they don't want to be messing with that. They want to meet someone in person. How do they react when you tell a joke? When you look into their eyes, what do you see? Like, okay, I just went off the cliff. I'm sorry. Maybe I should just make that a reality and try to make that happen, right? Starting a little pilot program, Chicago, Atlanta, Los Angeles, Seattle. I'll mingle, get it all together. I don't know, maybe a single event, it could turn into a subscription thing, right? Like if you don't mind traveling, there could be one in Los Angeles, one in San Diego, one in San Francisco, all in the state of California. You pay your subscription fees, you can go to any one of them. I don't know, I'm just talking out of my butthole. But as we turn our attention back to, there's a lot here, guys. My goodness, there's Mueller water products, another video script that I have ready to go, ready to film. It's basically all of the water equipment players, including Badger Meter, Mueller, Veralto, because I made a video talking about the water utility stocks, but I also wanted to talk about the sewage treatment, the ones that are selling the equipment to the municipalities. So I feel like for me, now that I understand that side of the house, rather than the utility water companies, I'd rather go into the water infrastructure companies. So please comment, please help me, motivate me, be like, dude, you got to get that video up. It helps, it truly does. I think the worst thing is when I put a ton of energy into a video and it gets no traction, no comments, no likes, it's demoralizing. But then again, it's not all for a lost cause, like some of the Confederate lovers, right? Like that was a state of rebellion that lasted, 3 years at most? And they treat it like it's a part of their identity. Like, get out of here, please. Because at the end of the day, by making this content, by continuously analyzing and researching and studying the stocks and the markets, it's genuinely made me a better investor. So think about it, right? If you're going to be looking at the entire landscape of a sector or an industry, it makes you that much more familiar with those companies, especially in earnings season or when the opportunities arise or when setbacks or growth catalysts are happening. And that's why, I always have to remind myself of that. It's like, you're not doing it for the views. You're doing it to be a better informed investor. And that's why I'm like, okay, yeah, you're right. And there's also Hercules Capital, another BDC. But then again, I went on that tangent about BDCs. I love them, but now is not the time to buy them. Marriott Vacations, a timeshare company. And then there's Big Bear AI. I'll be completely honest with you. I think there was a narrative saying they're going to be the next Palantir. Absolutely not. Because if you look at Big Bear, never has Palantir run into this kind of an issue where revenue is flat, or in this case, for fiscal year 2025, where their gross sales declined by 20%. Palantir, I think since their inception, it's only been growing at an astronomical rate. So when people try to put Big Bear, just because it has the name AI does not mean it's going to go to the moon. And I think they were doing a lot of, software associated with airport security, right? Then again, I feel like Palantir is going to be able to eat up whatever it is they're trying to do at a better rollout, if that makes sense. Big Bear AI, the reason why I have an opinion about them is because I did an analysis on them. And at the time I said it's a D+, watch list, wait list. I don't know. Now I know. I would say they're in the F tier. I just don't believe in them. They're 6th Street Specialty Lending, another really high quality BDC. And then also on Tuesday, I wanted to talk about Tempest AI, ticker symbol TEM. They were at one time one of the hottest stocks. I think one of the politicians, they had to make a public filing, say, oh, I'm investing into it. And then everyone was like, wait, why are they investing into this? And then they pumped. I think it went from $30 all the way up to, $96. But Tempest is a part of the SaaS sell-off. And I guess to take a step back, what exactly is Tempest? It's basically a cancer data operation software that finds the best treatment plan for the individual. Because when it comes to oncology and cancer, it's not a one solution fix that works for everyone. You just have to put this pill in your butthole. Or you just have to put this thermometer in your earlobe. No. Different people, depending on their DNA, they respond differently to different treatments. And they also sell the data of cancer across the board to the various pharmaceutical companies so that they can research and develop drugs for treatment. So on the spot, if I had to think about Tempest AI, I would say it's a tier 2 company. They have proprietary data on cancer, but also with all of the various patients that have submitted their blood work and their tumor samples to understand what works and what doesn't. You can't get that database overnight. You can't just vibe code that. Right? So Tempest AI, I'm not going to lie to you, as they're selling off, I kind of regret that I did not have them on my watch list. But because of this Compounder's Corner, this earnings week, they are going right on my watch list. And the story behind the business is absolutely incredible. The founder's wife, she was diagnosed with breast cancer, I think in 2014 or 2015. And the absolute frustration with her treatment is what led him to create the business. And he was previously a co-founder of Groupon, which is a terrible coupon online platform that sucks. So lucky for him, Tempest AI is a lot better. So if you're bullish on genomics or using AI to pinpoint the specific mutations of cancer, this one's for you. And the crazy thing is, I actually have a classmate who works there as a scientist. But the thing is, I feel like it would be awkward if I were to just hit her up and be like, hey, how are things going? Trying to get some. That would be weird. But she's actually really smart. So the fact that she works for Tempest AI, I guess it's kind of like a personal bias, but I have a good opinion about Tempest AI. I'm like, It's the same thing with like Palantir. I forgot who it was, but there was someone like 3 years ago where his investing thesis, he's a very strange but interesting individual. He doesn't care about the numbers or the financials. All he cares about is the screening criteria in which you hire applicants. In that, do you hire the best and the brightest minds, the best that America has to offer? Like, what is their average SAT? I know this is a terrible example because I don't necessarily agree with it, because I've met complete idiots from the Ivy League. And I've met geniuses that went to state schools. But anyways, he goes on to say, did they go to Stanford? Did they go to MIT? Did they go to a state school? Like, how strict and hard is it to join the company? And then eventually he came up with a list of business, or I guess stocks, where it's like it's darn near impossible to join unless you're the top 1% of like intellectual capacity, but also they don't care about cultural fit. They don't care about your personality. All they care about is, are you freaking like a genius? Palantir was, I think, like number 1 on that list. Tempest AI, that's the same vibes that I get. Because if you go to their LinkedIn and you take a look at their employees, just a bunch of smart Ivy League people across the board, right? So this one, let me just take some notes. I want to circle back on. I'm going to analyze the numbers because I think they did sell off with the rest of the SaaS. They reached a low of 41.73. And it looks like for the past 1 month, they pumped 21% into the green. So if you bought the dip, probably a happy camper, but I want to figure out what's their fair value, and then I want to figure out what's a good price to buy it. But so Tempest AI, definitely one to keep on my radar for Tuesday. And then as we jump on over to Wednesday, I think I don't want to bother with the bottom 100 companies of Tuesday. That's micro cap or small cap. So as we kick things off on Wednesday, there's ARM Holdings. I guess I should have mentioned them as part of the AI players that are reporting. There's Novo Nordisk. Look, I get it. There's probably a lot of you guys that are invested into Novo. I truly wish the best for you. I hope they go back up to 50, 55. The same exact people that I just addressed, I'm sure that you're probably going to sell out of them as soon as you break even. But like Novo is good. I truly think it's a good company. I just think they have poor execution, poor leadership, and a terrible supply chain. I think if you're going to release or go GTM with a groundbreaking product or a service, you got to make sure that your logistics are in place. Novo Nordisk, they pooped their bed. They weren't ready. And that's what allowed Eli Lilly to become number 1 in the weight loss drug market. You think about Novo Nordisk, they should literally be a $500 stock. I'm not joking when I say that. They messed up so badly. But anyways, hopefully things can turn around for them. And then there's also the Walt Disney Company. You know, between you and me, at one point this year, I thought Disney, call me crazy, I thought they were undervalued. But just like Duolingo, just like the Trade Desk, just like Roblox, I think the negative commentary and the narrative that's surrounding the company does have some merit. The pushback does make me kind of pause, right? The reduced international visitors to the theme parks in California and Florida, just across the board, you take a look at the numbers, the amount of tourists coming to the US due to the current state of political affairs, but also the hostility to immigrants, or I guess illegal immigrants, it's really off-putting, and a lot of people are canceling their vacations to the US. Consequently, it's also hurting the travel industry. A lot of the hotels are feeling the pain. A lot of the restaurant chains and tourist spots are feeling the pain. Las Vegas, for crying out loud, is feeling the pain. So it's crazy how much can change from administration to administration. But then there's also the questionable, I guess, path in the leadership, especially with Bob Iger stepping away. And I guess for you guys, the retail investors, I feel like what riles you up the most is the polarizing messaging in their content. So when I think about Disney, look, I like the company, but the stock is a different ball game. And there's a ton of things in life where the product or the service might be spectacular, but the stock might be something you want to stay away from. Disney, unfortunately, it might fall into that camp. And I say that as a guy that really likes Under Armour. Now, I used to be a super meathead. I used to lift heavy, try to get as big as I can, and I stopped. It's super expensive to eat all that protein and to maintain your muscle mass. But anyways, huge fan of Under Armour. Okay, I think the clothes, the apparel, higher quality versus Nike. Now, obviously, I haven't bought anything from Under Armour in years because I live in Japan. So maybe the quality went downhill. But I would never invest into Under Armour, the stock. Does that make sense? Just because you like the product or the service, it doesn't necessarily mean you should invest in the stock. Under Armour, I think it's going to be like that. But also on Wednesday, we have Uber. I'll be honest with you, Uber, since their last report, they've basically been trading flat. I think the markets, investors, are just waiting to see what happens. You either buy into their vision or you don't. Right now, they're the pound for pound biggest rideshare food delivery app service. Okay? And I think it's a very polarizing company. Because if you're a taxi driver, you probably hate their guts. If you drive for them, you probably hate their guts. But as a consumer, you probably like Uber for how convenient it is that you can just pay $20 to get from A to B. Okay? And very recently, they opened up a partnership with a hotel reservation company. So not only can you book your ride, but you can also now book your stay at a hotel. So they're trying to become a one-stop shop for everything related to the travel space. My whole thing is, I like Uber, but we can't deny the fact that Google's Waymo, that Tesla's, I guess their own vehicles that can drive themselves, but also Amazon's Zoo X, they're ramping up. And when I say ramping up, I mean millions of rides are being conducted every week versus thousands just a few years ago. And based on market research, I could be wrong, but with Waymo and Zoo X, you pay less than Uber. So think about it like this. With Uber, you have human capital involved where you have to pay them more. But with Google's Waymo, the cars are driving themselves that are a depreciating asset that helps your books to write them off for your tax loss. And you don't have to pay a driver. Does that make sense? Unless, of course, we're being fooled and there's some poor soul in the Philippines driving the car virtually, but we're all just pretending like it's AI driving the freaking car. That could be a reality. We don't know. So I think with Uber, I think that's genuine concern. But if you think about it in the light of, okay, an app where you can book a ride from the airport to your ex-wife's condo or a hotel or Airbnb or a train, if you think about it like that, I kind of like it. But then I would push back. I just thought of this right now. Everybody and their grandma has Google Maps downloaded on your phone, right? Unless you're an iPhone user, okay, whatever, Apple Maps. It's not that difficult to integrate Waymo into Google Maps. You already have the app. So why not just integrate a feature where you can also book a ride with Waymo? So when I think about it like that, that's one of the reasons why I just cannot jump in. Likewise with Duolingo, I just can't jump in. I think I told you guys, I think in December, Just for fun, I was considering Netflix, Uber, and Duolingo just for fun. Out of the three, I would rather go with Netflix. So, yeah. And then there's also CVS reporting on Wednesday, which I think as of right now, at the time of making this video, they're at all-time highs, $82 a share. You zoom out, no, they still got some more room to go, but in the past 1 year, they're at the highest price they've been at around $82, $83, $84. And I think the health insurance stocks are going to continue rallying, like I said, as the midterms are pending. Marriott International, now that's the actual hotel chain, whereas earlier it was the time control, or the earlier was the timeshares. I was reading Johnson Controls, which make the little, what do you call it? The thermostats for like HVAC equipment. They do a whole bunch of like random stuff related to HVAC and plumbing and all of that. It's pretty good. It's a pretty good one. There, let's see, Warner Bros. Discovery, Coherent. Royalty Income Corporation. They're one of the staples in my dividend income portfolio, which, by the way, 95% of my capital is allocated towards dividend growth, or GARP, growth at a reasonable price. 5% of my capital goes to dividend payers like Royalty Income or like Altria or SCHC, just to fill you in on the loop. I'm not the kind of guy that's going to go 100% into Royalty Income or 100% into Western Union or something like that, because I understand CAGR, total return, the upside is pretty much capped with like Royalty Income, Altria, right? Because they're very established, very mature, but the juicy dividend yield, like if you're living in retirement and you rely on cash flow, it makes all the sense in the world. But at 35, yeah, I'm trying to get my portfolio to $800,000, and I feel like it's not the fastest way to get there. It could be a safer way to get there, absolutely, if I just reinvest and drip the dividends. But that's for a conversation of its own. And by the way, I just uploaded a video talking about why I don't drip, which is episode 6 of the Cheese Portfolio series. Might want to check it out. There's Restaurant Brands International. I am almost positive this is the Popeyes. Is it? Yeah, it's the Popeyes, Firehouse Subs, Burger King, Tim Hortons. And I also think they're selling off. I think everyone in the restaurant space is selling off, right? Even Domino's Pizza, for crying out loud, is selling off. There's TKO, which I think is the parent company of the UFC and WWE. Let me see if I'm right. Oh, yeah, WFC and WWE. To be honest with you, I like this one, but not at a trading multiple based on next year's EPS of 36. A little too high. I would buy into them, just not at their current price, if that makes sense. Oh, and then let's talk about Axon Enterprise. Do you guys remember I talked about them 3 months ago prior to their earnings, and they popped by like 30%, and then they went on a sell-off because I think they're also associated with the military-industrial complex. They're basically in the business of selling tasers, body cams that almost every security officer or police officer has to wear after the pandemic craziness that happens with brutality being caught on film. And then they also do secured cloud networks, right? So when you have that body cam footage, it goes directly onto their cloud that can't be hacked. And their customer base, pretty simple, it's B2B. Law enforcement, border patrol, and ICE. So the reason why Axon was pumping, the current administration, as you guys know, is driving a crap ton of money into hiring as many bodies as possible into those 3, I guess, bodies of organizations. But I think one of the reasons why they're selling off is the pending midterms, like I talked about. So let's see if we can zoom back in. So yeah, the last time we talked about them, or actually, golly, in August, they were $842 a share. They are half of that now. I think this is to be honest with you, with Axon, I am a little too scared to go near this company. But anyways, the last time we talked about them, I think they were like, what, $5.20 a share. They rallied up to $6.40, $6.50 a share. They sold off. just like the military stocks, there's more room to fall. And let's see. Scroll down. There's Kraft Heinz. Look, if Berkshire Hathaway went on record by saying that it was one of their biggest mistakes ever, I feel like an idiot too, because I invested into the food CPG stocks as well without understanding the implications of private label brands, where 9 out of 10 times is also made by the name brands, but they put the private label on it. Lower margins, lower profitability, lower revenue potential. Yeah, I lost money on it as well. So if you're thinking about Kraft Heinz, I don't get it. You have to let me know, like, what's the growth catalyst that's going to make everyone jump ship from buying the Kirkland brand at Costco, or the Great Value brand from Walmart, or what's the Target private label brand? Is it Essentials? Whatever. What's going to stop the consumers from buying that, the store brand, and then going back to buying the name brand stuff? I don't see the reversal happening anytime soon. I think with inflation, the consumers are realizing, like, you know what? It might not be as good, but I'm going to go with it anyways. In the realm of food, I think once we start talking about like best in class stuff, like laundry detergent or dish soap, I think there's a clear differentiation between the cleaning powers of Tide versus store brand. Dawn dish soap versus Palmolive. You got to use twice as much of the substance to get half of the crap, the grease off. But for food, you know what I mean? It's different. So personally, I'm not interested in Kraft Heinz. And as we scroll down and take a look at $14 billion, the New York Times company, are you kidding me? There is Elanco Animal Health, a pharmaceutical company that makes vaccines and medication for cats, dogs, livestock. I think they're one of the only... No, that's not true, because there's also Merck. No, wait. Hold on. I think Merck... Merck, they also do animal pharmaceutical stuff. And then there's also Zoetis, which used to be a part of Pfizer, but they did a spinoff. So, yeah, there's that. And as we take a look at Zillow, I think that's an interesting one, right? When you think about Zillow, you would think they would have high margins, a lot of profitability, basically erasing real estate agents from the equation sometimes. I think a lot of the listings, they do have an agent or a broker, but there's also an ability for people to list their homes and try to sell it themselves. You would think a platform like that would be flush in net income and free cash flow, but that's just not the case. I was taking a look at this company earlier, and they're burning through cash to stay alive. It's quite bizarre to think about. You would think a company like Zillow should be crushing it, but the fact that they're not, to be honest with you, it's perplexing. Fiscal year 2022, check this out. They had $4.3 billion of free cash flow, which is good. And in fiscal year 2025, their free cash flow is now $235 million. So that's a decrease of about 93% in the span of 3 years. They're burning through cash to stay alive, and I think their stock price is reflective of that. In the past 5 years, negative 66% return. In the past 1 year, negative 31% return. I think that's because Zillow is also being categorized and grouped with the SaaS sell-off. Like, people are just going to vibe code their own real estate social media platform, which, I'll be honest with you, I'm not buying it. If Zillow already has it done, and there's also a crap ton of competitors like Redfin, Truvilla, and what are the other ones? Realtor.com, Homes.com. It's already a saturated market. So I feel like if they're part of the SaaS sell-off, I think it's overblown. But Zillow, definitely not a company that I would personally want to invest in. Yeah, and then they also have a cousin from West Virginia called Open Door. It's basically the Carvana of the real estate online market, where they don't give a crap. They'll buy your home. And then what they do is they sell it off to a real estate investor. So if you don't want to deal with any of the hassles of like showing your home to 20 potential families, you just sell it to Open Door at a lower market rate and be done with it. Now, Open Door earlier this year, was it last year? They went through like a short squeeze frenzy, but it's kind of bizarre to see the online real estate stocks suffering when I feel like they should be thriving, right? I don't know. It just blows my mind because back when I was getting my MBA, I went through this like incubator pitch class, and my team and we were trying to, I guess, sell a digital home inspection service that's standardized, that would be, for a lack of better words, make the entire process more transparent, but also, I guess, ride the tailwind of the real estate boom during 2021, 2022. But obviously that's not the case anymore. There's a lot more sellers than there are buyers now. And the reason being is that a lot of the folks that bought their homes when the interest rates were non-existent, why the heck would they want to sell their home to get a new mortgage at 6, 7, 8, 9%? It doesn't make any sense, right? So they're staying in their homes. And then there's people that can't buy the homes because they're at historically high valuations. So we're at this really weird point in time where the real estate market is it's in a hairy situation. But then the mortgage rates can't come down because the federal interest rates are staying flat. So yeah, it's kind of crazy. You want to hear another crazy statistic? Around 16% of all millennials are now net worth millionaires. So 1 out of 6 millennials. Just when I thought I was catching up and doing well in life, dude, I'm nowhere near that. And I think a lot of that is because people that were born in 1981, 1988, my peers, a lot of them have home equity and their homes have been investing, but they also have 401k accounts, a dividend portfolio. Should easily push them into the millionaire category. It's kind of an interesting dynamic. There's a lot more millionaires than ever before for our demographic. While at the same time, the economy is kind of in a weird situation where there's layoffs happening. We can't afford to buy homes. The cost of gas at the pump is like freaking $4.80 a gallon. I don't know. I'm reading the headlines because I live in Japan, right? We're at a crazy time. It's a crazy time. But moving on down the list, we also have Watts Water Technologies, another infrastructure play on water. There's Chime Financial, which I did a deep dive video on them, and I'm just not feeling them. I'm just not feeling them. And I think, there are some other names, but I don't think any of them are worth calling out. So let's go ahead and jump on over to the next day. Just one more swiping down in case. Oh, there's Sezzle, the buy now, pay later app, which among Affirm, Klarna, and all of them, Sezzle would be my pick. Reason being is I did a deep dive on them and I really like their numbers, their trajectory, and how they have like a specific niche of the market that they've carved out for themselves. Basically, buy now, pay later, it's micro loans, which is kind of crazy to even say. Because like when you think about loans, you think about like student loans, right? $80,000 or a mortgage loan, $800,000. But buy now, pay later, micro loans on a $10 Chipotle burrito. $20 for a DoorDash delivery. It's kind of crazy. I guess as a follow-on to what I was saying, so many freaking millionaires, and yet the other side of the spectrum, we're taking out loans to buy a Chipotle burrito. Like, it doesn't make any sense. And oh my gosh, Thursday, there's 550 businesses reporting earnings. To be honest with you, I'm not going to do all 550. I'm going to just speed run, or actually, let's only talk about and address the biggest players. There's McDonald's. Okay, we can talk about that. We've heard it all before. The consumers are fed up with the value menu being expensive, tastes like crap, whatever. That's one of the implications of inflation. Because the food never tasted like crap. It's just people are saying that it tastes like crap because the price of it went up. Now, why did the menu prices go up? When the COGS, the cost of goods sold, and the SG&A, how much you're paying your employees go up, so do the price of the burgers. You can't increase everything and keep the prices low. That doesn't work, right? The operations would go belly up. If you're going to increase the price of everything, you got to increase the price of everything. You can't just pick and choose. But anyways, I like McDonald's because when you think about it, fundamentally, at the end of the day, they own the most expensive real estate around the world. Whenever you see a McDonald's in Paris, in Munich, in Amsterdam, in New York City, in San Francisco, in Seattle, in whatever major city, they own that plot of land and that building. And then what they do is they lease it back out to the franchisees that do all of the heavy lifting and running the operations. And then they pay their royalty fees, their marketing fees, and kickbacks to McDonald's headquarters to operate under the McDonald's brand. It's the exact same playbook as the hotel chains. And with McDonald's, I'm actually really bullish about their high margin cosmic drink cafes. They're rolling out. You see it all over social media right now. People are bagging on Starbucks, Dutch Bros. Like, why would I pay $7 for a cup of coffee when I can go to McDonald's to get a big ass, like 1 liter of coffee for $1.50, for $2.50? I don't know what's happening, but social media is hyping up McDonald's beverages. And I'll give you guys a solid heads up. I usually say, oh, on Patreon, this or that. No, this one I'll give for free. I've been dollar cost averaging into McDonald's. McDonald's is one of the few blue chip companies where buying the dip makes sense almost every single time. The narrative changes as to why they're selling off, right? 1980s, 1990s, 2000s, but time and time. Here, can we just pull it up? But Amos, past performance is not indicative of future gains. Yes, I understand that, but we're talking about McDonald's. No matter what, they always find a way to bounce back and to go up and up and up. Their total return is 163,000%. Okay? You take a look at the past 5 years, whenever they go on these little dips and reach a valley, oh, they bounce back up. Whenever they reach one of these valleys, they bounce back up because McDonald's in the fast food landscape is S tier. They're best in class. Right now, they're selling off hard. In due time, exactly what happens in the past. That's what I'm saying. Like, past performance does not mean the same thing is going to happen in the future. Likewise, in the same vein, you can also look at the past to see what kind of happens with this company. And consistently, they just produce numbers, right? Since 2020, it's just been going up for their gross sales. The numbers have declined slightly because they had to close some major markets, including Russia and some parts of the Middle East because of the conflicts, or I guess the invasion of Ukraine and all of that, which makes sense. So I think that's not a fair thing to look at. I think the fair thing to look at is the EPS. Because regardless of the gross sales coming in, as long as your profitability and your margins stay intact and the efficiency of the operations are good, the EPS should still be going up. And that's exactly what we're seeing, right? 2016 is $5.44. Now it's $11.95. So it's good. And as a proxy, if we take a look at their free cash flow per share, hopefully it's still good. What do you know? $4.92 in 2016. Now it's $10.03 in 2025. Dividend profile, 2.6% dividend yield, 51 years of growing the dividend. Think about it. In the past 51 years, think about all of the major catastrophic, disastrous events that have occurred. The dot-com bubble crash, the great financial recession, the pandemic sell-off, the bear market of 2022, the April 2025 tariff sell-off, and again, the March 2026 Middle East conflict sell-off. Through it all, the dividend grows. So for me, especially a channel whose name is Dividend Compounders with Cheese, it would be ludicrous. It would be insane for me not to buy into McDonald's. So I'm personally buying this one. Don't follow me into it. Learn from my mistakes. Let me learn the hard way that this was a falling knife. But I'm just going to be putting my money where my mouth is, and I'll be buying it. I have no issues with it. And there's also Mercado Libre, the Amazon of Latin America. There's Airbnb. There's a lot of oh my goodness. I feel like there has to be two parts of this video because there's also Republic Services, which the other day Waste Connections reported their earnings. It was beautiful. So if that's an indicator of how the waste disposal landscape is going, then I think Republic Services should also be reporting good earnings. And then there's Coinbase, which is kind of like a cryptocurrency exchange. There's Datadog, Becton, Dickinson and Company. They sell a lot of like medical equipment and hospital supplies. There's Kenvue. Okay, it's the parent company of Band-Aid, Tylenol, and Listerine, formerly a part of Johnson & Johnson. They divested, got rid of them, and they're about to be acquired by Kimberly-Clark. Now, I'll say this. I think it's a good deal for Kenvue shareholders, not exactly good for Kimberly-Clark. Because Kimberly-Clark right now, they're drowning in debt. And their landscape, it's just hard to feel bullish about Kimberly-Clark. I would actually just categorize them into a high passive income retirement portfolio. I definitely would not see myself investing into Kimberly-Clark. But Kenvue, I wouldn't mind. But the reason why I wouldn't want to invest into Kenvue is because in a matter of time, I think in like a couple months, you're going to get bought out. So for whatever shares of Kenvue that you have, you're going to get Kimberly-Clark shares, and I don't want to be invested into Kimberly-Clark. Well, not at this age. Obviously, that opinion could change in the next decade or so as I get closer to retirement, but yeah. And true to my word, we're only going to be talking about the big dogs, the large cap companies, Carlyle Group. There's Toast. I really like Toast. I sold them for a profit last year. It's a tier 3 vertically integrated software for the restaurant landscape, right? They take care of everything: reservations, supply chain, inventory, the register, refunds, everything. I really like them, but I think, to be honest with you, I think their sell-off, obviously the SaaS sell-off, but also I think investors were baking in an economic downturn. But, you know, economic downturn be darned, their numbers are still so freaking good. It's almost scary. Gross sales, 24% increase year over year. Their EPS increased by 1,600% year over year. They're finally profitable. Cash flow, let's take a look at this. Free cash flow grew by 99% year over year. There's a lot to like about Toast. I think out of the tier 3 players, besides Shopify, I think Toast is probably one of my favorites. I really like this one. I wouldn't mind jumping back into them. Actually, I'm going to take notes. I might have to circle back and research this one. I think Toast is a pretty good one that I do want to do more homework on again about a proper entry point. There's MP Materials, DraftKings, The Trade Desk. Oh gosh, I didn't know The Trade Desk was reporting on Thursday. So as you guys know, I invested pretty big into them. I'm down by like 50%. Average cost basis is like $40 a share. Kind of sucks. From what I can tell, their numbers are still pretty spectacular, right? Gross sales 18% year over year. EPS pretty good. Free cash flow is bonkers. Balance sheet is good. I think the narrative is they're baking in that the trade desk is about to go belly up for their advertising practices with some of the agencies. A lot of them are saying, let's rally together and boycott them. But also, Google and Amazon is encroaching upon their territory of advertisements on the open internet, which I don't understand how that doesn't open up the door of antitrust monopolistic practices. But then again, I feel like that was more of the ball game of the previous administration, where they were breathing down the necks of Amazon and Google all the time. I feel like with the current administration, I think businesses are able to roam a little bit more freely. So that's why the trade desk, I think they're bleeding by 1,000 tiny paper cuts right now. I'm not lying to you. I think every week I contemplate, should I sell at a loss? But I don't. I hold on because I'm like, I still think they're undervalued. I think they're going through a pretty tough situation right now. But yeah, there's Texas Roadhouse, which I invested into them in 2019, and they've been one of my best performers. I don't really talk about them because I only have like 2 shares, right? That's not a major position. That's nothing to write home about. Some of you guys make $100 an hour. So for me to talk about a position that I only have $100 invested into, which I think $50 per share has turned into what? $158 per share. So yeah, my ROI has been pretty phenomenal. I invested into them like, I don't know, like right here, September 2019 at like 54, 51 bucks. Pretty good return. I don't know why I never sold out of them. I think I just let them compound, right? Like let your winners ride. Because I think there's a philosophy of like, why punish your winners by trimming them too soon? Because then you'll never see the compounding effect of NVIDIA, Broadcom, AMD. And I think that kind of got to my head with Texas Roadhouse, and I just let it marinate. But I think after this earnings report, I'll assess the situation. I think from my understanding, they're crushing. Their operations are thriving. But I think what's hurting them right now is inflation, especially with the cost of beef. In Japan, the cost of beef is pretty cheap. But I think in the US, correct me if I'm wrong, but beef should be pretty expensive, right? And Texas Roadhouse, their main commodity is steaks. And so if they're selling the exact same piece of steak for $15, which previously cost them, I don't know, $7, $8, but now it costs them $11, think about it, right? So they might be making the same amount of revenue, but their margins, the profitability, the net income, they're putting a lot less money into their pockets. So for me, I think of it as like a temporary headwind. Maybe I shouldn't sell out of. Maybe I should just let them ride. What am I saying, right? Why punish them for being such a phenomenal business? But anyways, let's jump on over to Friday and take a look at. There's Toyota, which I don't know if you guys are aware. I'm going back to the US very soon, and I'm looking at cars left and right daily, trying to get a good deal. And we have some delusional folks that are trying to sell their minivans, Toyota Sienna with 300,000 miles for 20 grand, just because it has a Toyota badge. It's off-putting and it's offending me. I'm almost to the point where I don't even want to buy a Toyota anymore because I don't want to deal with these folks, right? Because 4 years ago, I kid you not, that exact same Toyota Sienna, you'd have to give me $500 to take it off your hands. Because at 300,000 miles, you're just asking for transmission work. I don't give a crap that it's a Toyota. At 300,000 miles, the rubber, the gasket, everything that makes the car stay put is going to start to show signs of age and wear and leaks. You're going to be dealing with crap and taking it to the auto shop, repair shop, maintenance, mechanic, weekend after weekend. So I'm not even considering 300,000 miles. I think I told you guys, at this point, I threw in the towel. I don't think I can just get a normal gas combustible engine anymore. Why? Because the used car market is just stupid. So now I've defaulted I've already set my mind on getting a used EV. EVs that used to cost 80 grand brand new are now selling for 20 grand. I'm not exaggerating. You talk about Tesla Model Ys, you talk about Polestars, you talk about the Ford Mustang Mach-E. Those are really good family cars as well, trading for a fraction of the cost with like 20, 30, 40,000 miles on the odometer. Yes, I understand the whole ramifications with the battery and everything, but I'll take my chances because I'm not about to pay some delusional guy 20 grand for 300,000 miles on a 20-year-old minivan. I'm not going to do that. I'm not going to do it. Just like the value investing, it doesn't align. It doesn't make sense. But anyways, there is Oshkosh Corporation, which I really like this one, right? They make various types of equipment, fire trucks, transportation vehicles for the military, airport, tramway stuff. I really like them. I don't like them at their current price. I would like to buy back in. It's a company that I made a fat profit on, I think like a year or two ago. I just never had the opportunity to jump back in. But anyways, I think Friday is going to be pretty quiet. There's nothing too crazy that stands out except for Oshkosh. Oh, and there's Wendy's, which is hilarious. So we have McDonald's, which I think is best in class out of the fast food burger stocks. And then there's Wendy's, which I think it tastes pretty good. Obviously, I'm not known to have a Michelin 4-star tongue because I went on record by saying I like Domino's pizza better than New England white sauce clam pizza that tastes like a bag of ass for $40. I was like, what the heck are you guys smoking? You kept telling me when you go to New Hampshire, when you go to Connecticut, you got to try the white sauce. I was like, dude, this tastes like a bag of ass. Whereas Domino's, I think it tastes phenomenal. Anyways, Wendy's, I think it tastes pretty good. But in terms of a stock, absolutely not. But anyways, I hope you guys enjoyed this episode of the Compounder's Corner. Let me know your thoughts. I think there's a lot of questions that I asked. Please do respond. I don't want to act like a schizophrenic where I'm talking to myself for an hour and a half with no feedback, right? That would be crazy talk. But anyways, I love you guys. Stay safe. Good luck in the stock market. And please do not allow emotions to drive your decisions this week in the stocks, in your personal relationships, or in the workplace. Okay? Be logical. Be smart. Save your tongue. Don't act irrational. Don't act crazy. And if you love the content, please support the channel and hop on over to the Patreon. Other than that, I'll talk to you guys next time. See ya!